Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to try to make it worth your time and have some fun on this journey of financial planning, your personal investing journey, as we take a look at three-dimensional investing, looking at all sides of the issues and bringing that professional perspective to the table for you today as we talk about no pension, no problem. And we're going to be talking about the fixed income slice of the pie here. It's a massive industry. When you take a look at the difference in how much money's out there working for, all these different slices of equities and investments, it's roughly 70% of the marketplace is in this fixed income slice, this bond piece. I'm going to go straight into it. Ben, Dan, how are you guys today?
Good, Seth. How are you doing?
Doing good.
All right.
Well, the stock market has definitely grown over the last few years, and the interest of parking money has grown. But the bond market is easily 2 times the size of the stock market. But we don't have that conversational piece on a daily basis.
No, it's definitely not capturing the news like the beam stocks and all these other things that are, they move quicker, a little more trendy. Everyone's on their phone trading all day.
All you're posting on Reddit, Dan, is
that's right.
It's overwhelming.
Yeah, but so it just doesn't have the kind of the name brand recognition in the pop culture world that the stock market does. But, if you just weigh it by the vast volume of dollars involved, it's significantly larger. It's not even close.
Yeah.
So there you have it. Surprise behind door number 1. You've got fixed income investing, folks, and we're going to be diving into that with you. Before we do, it's time for Money in the News. Well, if you haven't heard, oil prices will surge to $100 this year, Goldman Sachs warns. Thank you, Matt Egan with CNN Business, bringing us this piece of news for you today. And as far as we're concerned, or I'm concerned, I'm pretty darn excited to hear that. Just pounding and beating this drum for how long?
I want it to surge. We've been long energy for a while now. And it's funny, when reading this article, they're projecting into the year $100 a barrel, and they're saying next year it'll be $103. And I've read articles, and I was telling somebody the other day, I think oil's $120 a barrel. I'm not an analyst, but there was some speculation. J.P. Morgan and another company, I can't remember what it was, but $200 a barrel is what they were saying. There's a couple articles we referenced. I remember that a while back. It was like 6-8 months ago that the shortages, the fact that we were turning off wells and all of that could potentially, if we got to the point where we just had no more storage and they shut everything down, the restart and the drawdown from an instant kind of a recovery. Like if you say, hey, we stopped everything in the world today, but then all of it started back up, the same number of flights, the same number of everything, we could see a $200 a barrel. You can't make alternative energies affordable unless oil is so expensive that they start to equal out, right? That's just the simple math, right? If you can buy a gas car for $30,000 and you can buy an EV car for $50,000, well, how do you make up that $20,000 difference or $10,000 difference, whatever they are? Gas has to be significantly more expensive. That's the only variable piece, right? So that has to continue to climb. And what we're paying for oil here in the U.S. is significantly lower than the comparable in almost any other country. So it's cheap for us. You can still buy a gallon of gas cheaper than you can buy a gallon of milk.
That's true.
Think about that, right? It's almost half as much still. And we're thinking how horrendously expensive it is.
Yeah, I think it's just wherever the starting point is, we don't realize it that same way. We're not measuring it to milk, but we're measuring the increase in the cost at the pump every week, right? So we feel like we're getting poorer, because no matter relative to what gas costs elsewhere. It doesn't really matter when it costs you $10 more this week than it did last week, right? That's the part that you notice.
Well, I haven't ever thought about the day that I've ever drank an entire gallon of milk, though. I mean, we use gallons of gas a day sometimes.
Well, I go through a gallon a day at my house, but it's it's still painful, but not nearly as painful.
Well, it's true. You do use less gas than I do. I mean, you live like 2 miles from the office.
Yeah, I live a quarter mile from here, and I got 3 kids, so I'm going through just about as much milk as gas. So.
Well, I think the thing is that whether oil hits $100 or $105, I think we can all agree that we're in a crisis period or some level of major concern on the price of oil and how it hits our pocketbook. And we do. You're right, Dan. We completely base our financial well-being on the price of the gasoline at the pump. It's something we use every day, and we use a lot of it, but it is something that we completely equate to our financial health. So Citigroup says that not only do they agree with the increase in the barrel cost, but they also think that by the end of 2023, they're going to see a massive decline. I would say that's aggressive. I think I lean more on the Goldman Sachs side of this, and I don't think we're going to see a petering down to the $54 a barrel that they're projecting. But it could happen, absolutely. Could happen.
Yeah, I mean, there's so many influences on this, and we didn't even touch on all the geopolitical stuff between what's going on with the pipelines out of Russia into Germany and the Ukraine and all that. But all that stuff is going to have an influence here too, and those influences can come about real quick and have a dramatic effect on everybody.
Thanks for the positive news, Dan. All right, next up.
Speaking on that note, I want to first of all just thank you, Morgan Smith, for having a name that I can pronounce, because that's been a real challenge for me lately. When we come to the next article, it's the 10 fastest growing jobs in the United States. Some pay over $100,000 a year. And you know what? We just love bringing you something that's a little bit more on the lighthearted, but definitely a resource for you, as there's so many people trying to hack their way into, that next increase in their pay and, viability of their job as so many people in these industries are just becoming obsolete and realizing I do not have an opportunity to move forward here. So here's 10 of the top of what's available or what's really moving the workspace for you out there. And number one, no surprise, vaccine specialist.
I know at least a dozen of those. I feel like you find one of those every time you stumble out the door. But
every time you open up Instagram, you're a vaccine specialist.
Yeah.
I think the thing is that when I look at a list like this, and for our listeners, what does this have to do about money in the news? What is that relevant? We look for tidbits and we look for information. Where is the world growing? Are you willing to be able to pay somebody $100,000 or more to do a job? It's because the demand is so high that you have to pay them to do that. That means there's a business model behind there that you ultimately want to grasp at and figure out, is this an area that we have an investment opportunity? Vaccine specialist, I think Fauci's going to have a job opening there here soon. So I think that job pays over $100,000. But when you start going through the different lists, you got diversity and inclusion manager. Maybe there's not something there. But when you start talking and get into some of these other ones, like a machine learning engineer, not only are you talking about something that's really a very unique area, you need somebody who's not only software competent, but you need somebody who really understands the mechanical side of this thing as well. So they're taking the computer and the mechanical piece and they're putting them together. Like, well, that's a demand I can definitely see.
That's the whole AI industry, right? Which is clearly here to stay and growing. I mean, there's nothing but future ahead for that. And there's no doubt.
Exactly. And I think that's where we get some of that stuff.
Yeah. Also on the list, we got a process development specialist, or scientist rather. That's an opportunity in the biotech world, which is obviously another up and coming industry. And here in the Northeast in particular, there's a huge marketplace for that. That was number 5. We got number 6, business development representative. 7, search marketing manager.
This is interesting.
Yeah, I'm not really exactly sure what that is, but
it's when anybody's out there. I mean, anybody out there that's online is getting advertised to. The click marketing, the search marketing managers develop paid search marketing campaigns. really across these digital channels. And there's a lot of business moving in that direction because they realize they're going to become obsolete unless they're out there in front of you some way, somehow.
Absolutely. I mean, there's some other simple areas here that you've got, business system admin, and you've got analyst relations specialist. These are all kind of more on the generic side, and I would say there's probably not a lot to gain there. But why do we look at these articles? Because the encouragement piece here, I think, is for people to realize that you have to figure out where the business idea is behind all of these articles. Like, if you want to get in the front of the investment line, you have to start foreshadowing, where money's going to be spent, where companies are going to be developed, what companies are going to grow, what's going to, ignite from some need or concern that is just starting to materialize for us in our society.
Yeah, and I know we've looked at these lists before, and this is the first one, or I think this is significantly different than the other ones we've seen before. Anyway, in that usually there would be some jobs that were new and upcoming, and perhaps we were less familiar with, but there was always the mechanics and their accounting, general trades where industry and home building was on the rise, or things to that effect, whereas kind of traditional roles that we're all quite used to hearing about. But going through this list, I mean, this just points to kind of an underlying message that there's a new economy on the rise here. Things are changing.
Yeah, agreed. And if you notice, a lot of the stuff is not something that you're saying to yourself, that person needs to be in an office doing something, right? I mean, these are all jobs that probably can be done remotely and almost anywhere.
True.
Did we get the user experience researcher in there? Because that was kind of one of those.
Go for it, Seth.
Yeah. Okay. Well, that was number 8. And there's basically the researchers that are taking a look at motivations and preferences of behaviors to inform businesses and strategy and product development. And I guess one of the reasons why I'm like, ooh, that's kind of exciting is because, we spent a lot of time. I feel like we spent a lot of time really trying to understand behavioral finance, and this is in order for you to, engage a lot of the time. It's around you engaging with the market or your investment decisions, so that you don't shoot yourself in the foot most of the time. Is what we're trying to do. Is like, how do we help you get where you need to go and lower some of these obstacles, which so much of the obstacles in between you and your goals and what this whole thing is about for you is built around fear. And for us, that's a lot of what we're ultimately trying to make sure that we're getting in line for you. And we're going to be talking. I think it's a great segue for us, because that's a lot of what this fixed income piece is built around for our clients, is removing that piece that is fear-based for so many people, which is, will I have enough money or income in retirement? Because that is your lifeline, and it makes sense. How do you make sure that you do not run out of either one of those pieces for yourself? And fixed income is one of the solves in the space that we're going to be talking about today. So, Daniela Genovese, thank you so much, from Fox Business. Airbnb CEO predicts guests will stay weeks, months, or even entire seasons at a time. Hey, why not just move? I don't know.
Well, that's a good point, Seth. That's a good point. But I will tell you that I really think that there's some legitimacy to this article in a lot of ways. I mean, I have a couple colleagues that I was thinking about the other day that they were like, I work remotely. I'm just going to go rent a place for a month. I'm going to go sit on the beach and I'll work my days, and my evenings will be down in sunny Florida or whatever. I mean, it's becoming a norm almost, because you don't have to be where you live to get to your office every day, because where you live is your office.
It's interesting, kind of leaning back to the other article about the 10 fastest growing jobs. One thing we didn't touch on is under each of the 10 positions, it listed the areas of the country that they're hiring in, and they're virtually all in San Francisco, New York, or Boston, which are probably 3 of the most expensive places you could possibly even attempt to buy a house at this point.
Or want to live.
Right? So, kind of marrying those two articles together, right? You have all these virtual opportunities and these fast-growing jobs that pay well, but they're all located in places you may not want to move to or probably can't afford to move to yet. So get an Airbnb somewhere else, you know, and do the job from there.
I have an idea here. How many times have we talked about what are the top 10 places to retire? And a lot of those things are, how's the health care? is one of them, right? Or how far is your dollar going to go? Because that's a big deal in retirement, making sure that you stretch those dollars. Quality of life, all those factors, right? So why not take those 10 places? If you have remote accessibility, go spend a couple of years just kind of 1 month here, 1 month there, and make sure while you're at it, when you come across those places that are so great to live, and they have their reasons, not only do you just go there during the summer, but you go there dead of winter and make sure that that's going to work for you, unless you already have another plan in place where you're like, no, so, we're going to snowbird this thing. But
I think when we go to this Airbnb article, and just to kind of sum this up in a piece, for those who don't know, Airbnb is a publicly traded company. I think that's interesting is a lot of people think of Airbnb as like a Marriott or a Hilton or that kind of type of investment. It was interesting. I was listening to a newscaster probably a year ago, and they were talking about the current stock price of Airbnb and how it was pricing it over the value of Marriott and Hilton, I think, combined, or some crazy statistic. Just tells you how kind of priced that stock is. I think the thing about it that was really interesting was when they got to the end of the article, it's like, well, Marriott and Hilton, some of these properties they own, some of them they don't own. They just run the hotel space, right? They don't, and they pay rent essentially. But what's interesting about Airbnb is all they do is collect fees. They don't own any of the real estate. They don't have to worry about any of the cleaning. They don't have to worry about the taxes. All they're doing is collecting a fee for running a software platform. And just the tremendous low-cost expense of that was very, very interesting because people were trying to look at its enterprise value and try to figure out, like, what is this company really worth? I find Airbnb to be, and VBRO and all these different companies, I find them to be an explosion of opportunity potentially. The idea of the stock and what it's doing and how they're innovating is just really a tremendous opportunity. And I'm just curious how much of that, to have a company that you have no overhead really, other than the software and the employees to run that software and the facilitation of that and the fees. Other than that, it's just a cloud. It's just another technology. And you and I, Dan, the other day were talking about everything is technology. Like, what defines a technology investment anymore?
It's difficult to break apart sectors in the old way because just about everything literally is technology.
You've been listening to Money in the News with Money on Tap. And we today are going to get into this fixed income slice of the pie. And how does this work with you in your retirement? It's a huge market, roughly 70% in relationship to just the total equities market out there. So it's really vast, but doesn't get a whole lot of conversation around it. We're going to give it its due today because that's what we do at Money on Tap. We're three-dimensional investing with you today. Thanks for joining us. We'll be right back. Don't go anywhere. Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does, how it works, and how it can best help you with your retirement goals. It's absolutely free to you, and if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And today we are talking about no pension, no problem. It's going to be a good one, folks, because we're talking about fixed income assets. In all fairness, it's a really, really important topic. We don't mention this enough, and I just want to I'll be really brief. Money on Tap, three-dimensional investing. It's what we do. We're financial planners. We take a look at all sides of the issues. And, we used to say things on this show which were really significant and important to us is that, there's really no bad investment. There's definitely some that underperform. That's a for sure. We're not saying that. But, in terms of, what kind of investments are out there, those investments exist because they provide a certain aspect of what's important for the investment world, or you as a retiree or a pre-retiree or wherever you're at in your journey. And that's one of the things that we're going to be highlighting today is kind of some comparison and contrast when we're talking about the fixed income world. Like, what is that? Traditionally, it's going to say, hey, you're a bond investor. That's what that would traditionally say. With roughly 70% of the market out there in bonds, and it's a huge part of this market and what people have been using for years. But with that said, why is it that we're not spending a ton of time on this? Well, frankly, it's not the most appealing of conversations that most people want to have when we're bringing some airtime to you here. You're doing whatever you're going to do. We're going to have some fun talking about stuff. And when we talk about fixed income, not a whole lot of people just jump out of the seat like they can't wait to talk about this piece. And especially in today's marketplace, when so much of this fixed income is suffering because of interest rates. And where interest rates are at, well, those are drivers. Those are pieces that are significant to this asset class. So when I say comparison and contrast, we're not going to get into that quite yet, but there's some things that you're going to want to be paying attention to. So make sure you've got your pencils sharp and you're taking lots of notes here because Ben and Dan are about to bring order to this classroom of my mind creating chaos right out of the gate here. So thank you for balancing and fairly imbalancing the rest of this conversation, you guys.
Well, I'm going to tell you this is not going to be a fair and balanced conversation because we obviously have biased opinions on planning and successful approaches to that these days, and we've chatted about some of that. And the idea of no pension, no problem is really the solution that everyone's looking for because there are no pensions, right? That's why we're on this show, and that's why we're talking about this today. The bond market is a very interesting world, and it's something that's become more difficult over the years to apply to a retirement plan. I mean, it's just the interest rates, as everyone knows, has gone down. So the question is how are you paying for that? Like, how are we involved in the bond world on a daily basis that inflects such a large piece to our economic world? I mean, the bond market is so enormous. It makes the stock market look almost insignificant at times. But it is this quiet bear that's out there. But we absorb the pain of the bond market every day when we look at our savings and checking accounts when there's no interest. Right. Remember, there used to be checking accounts that used to have interest-bearing checking accounts? Like, that's not even an option. I mean, I don't even know that I bear interest in our savings account. So, and you look at money market funds. People have tons of money market funds. And there's all this money out there, and you're getting very low rates on it because these firms, these companies, these banks, these financial institutions, they invest in bonds, treasuries, any sort of economic lending feature they're buying into that makes sense for that financial method. But as we kind of go through the bond world, we talk about there's corporate bonds, there's municipal bonds, there's treasuries, there's junk bonds. I mean, the bond world just has classification after classification. And a lot of people know, municipal bonds is tax-free. Now, we've worked with a lot of clients that, own municipal bonds, quote unquote. But when you actually look at their tax return, they're not tax-free bonds because they're getting taxed either an alternative minimum tax, which is, their income is high, and then the bond is not AMT exempt, and therefore you have a taxable burden still. And then you have to ask the person, well, why aren't you in a corporate bond? Because municipal bonds traditionally pay a lower rate than a corporate bond because it's understood that we can pay a lower rate to you because you're not going to pay taxes on this. So we should all benefit from that decrease, and you as well. So that's one scenario. But then you start getting into junk bonds, and what's interesting is that, Dan, I remember junk bonds 10 years ago paying 10, 12%. I mean, ridiculous percentages. Now a junk bond's like 4 or 5%. I mean,
yeah, the yield in that entire world is really dried up, and it's been that way for quite some time. It used to be a place where you could go if you had, reasonable degree of wealth and park your money fairly safely and just live off of the interest payments. But that opportunity's dried up for all but the most extreme wealth, and for those people, they're still probably doing different things with their investment strategy than that. And because the yields just aren't there. I mean, there's just better opportunities.
Well, I had a client, and well, he wasn't a client, actually. He never was a client. I had a gentleman who contacted me years and years ago. I've mentioned this a few times on the show, and I probably never stopped talking about it because to me, it's just astronomical. I think he owned, I know for a fact it was GM bonds. I think he was making 10 or 11% return on those bonds, and all of his money was in GM bonds. And he was telling me that, my money's safe with GM. I don't care how they're ranked or this, that, or the other thing. I was like, there's a reason they're paying you that much rate because they can't get it anywhere else, And, we obviously all know what happened to the car manufacturers. And those bonds most likely went worthless. The default on all of that stuff was pretty horrendous. I don't know where he is. I don't even remember his name. I just remember sitting in his house arguing about it. And it wasn't really an argument, but it was more of like, you got to diversify. Something like, hey, keep GM. I love them. I own a Chevy. I'm all in on GM. But the idea that diversification was not an option because he couldn't afford to live any other way without all his money being there, that's a catastrophe scenario.
Well, I think we talked a little bit about kind of getting ready for taking it back to the basics of what is a bond, right? So a bond is when you make a loan of your money to an institution, a company, or municipality, and you get an interest rate, in exchange for that loan. So when you think of it as, I'm going to loan my money to this company for 10 years and they're guaranteed to pay me X interest rate, it's reasonably safe. Not a lot of bond companies default. But the value of that bond is going to fluctuate with how the interest rate environment moves, and that's there's an adage, there's just a simple formula of the fact that when interest rates go up, the value of the bond goes down. So if you can do anything other than hold that bond to maturity in a rising rate environment, you're going to be losing value day by day.
The way to explain that for our listeners is, that can kind of sound weird, like, hey, listen, as interest rates go up, your bond values go down. Think of it this way, we have what we call a bond par value, which is what you buy a bond at. It's either $100 a bond or $1,000 a bond. Could be $10,000 a bond. But using $1,000, if you lent money to a company and you lent them $1,000 and they said, we're going to pay you 0.5% for the next 10 years, you'd say, okay, great. That's better than my bank rate, which is 0.01%. So you'd say, oh, that's good. But all of a sudden, if interest rates go up, that means new bonds are being offered. And if someone came to you and said, listen, if you lend me $1,000, we won't pay 0.5%. We'll pay a whole percent, 1% a year for the next 10 years. And so you have a bond with $1,000 paying you 0.5% a year, and you have another $1,000 bond paying somebody 1% a year. Well, at the end of 10 years, you're going to get $1,000 back. Problem is that you can wait the 10 years for both of those bonds, and you're most likely going to get both $1,000 checks back. But in the meantime, if you want to liquidate that bond, no one's going to pay you $1,000 for the 0.5% bond, or pay you the same amount of money for something that's paying you 0.5% a year for 10 years as something that's going to pay you 1% for 10 years. It's going to decline. Your 0.5% bond is now worth less in the eyes of the beholder than the 1% payment, right? Everyone wants twice the interest. So that's what happens. And with rising interest rates, like interest rates are so low, like they're talking about rates rising, and I'm saying it was 0.3%. I mean, interest rates have risen 0.3%. That's a 20% rise compared to where it was a month ago, but that's nothing in the bond. We got a long way to go to get where we were. I remember my first mortgage, which we were a first-time home buyer, was like 6.5%. Or 7%. And that was asked. People were like, you got to be kidding me. You got a mortgage at 6.5%. I mean, those are the types of things that people don't understand, is that we have a long way to go to where a healthy interest rate environment really is, where it's like 3 or 4 or 5%. I mean, that's kind of a healthier rate, and that's where the Fed would like us to go. So with knowing that we have a trajectory that the Fed wants to go up, we know that the current bond market, what you buy today, is going to be worth less tomorrow. And that's a scary thing when it comes to fixed income, because fixed income is literally considered one of the major slices to the retirement pie. When I think about fixed income, I get very concerned. And we're going to talk a little bit about one, again, this bond market, what people are doing to complement that bond market, and how do you mitigate statistical financial viability to stay retired with a rising interest rate bond market. And I think that's where we're going to go today.
I think so. We're going to take a quick break. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. When we come back, we are talking about no pension, no problem, the fixed income world as a solution to your retirement. What you need to know. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
Now back to Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking today about no pension, no problem. And it's just fair to say this is really good in a conversation around your personal investments, and how do you back yourself into this retirement question. And income is so critical, right? It's the driver for the rest of your life of how to figure this out and make it last. That's a part of the equation here. You don't want to run out of money, but how do you give yourself the freedom to just live in this space? And so the pension question is no longer the question that it used to be, which means that there's just not a whole lot of people out there providing these pensions. But you, as a retiree, want to somehow create this pension for yourself, and fixed income is the traditional space to do that, right? That's what we're talking about. In the way that's been done traditionally is through the bond market, that slice of the investment world that really doesn't get a whole lot of conversation around it. Dan?
Yeah, so, the question can come down to, well, where do bond fits, or do I even own any bonds? And there's lots of different elements to that, but really what it comes down to is where bonds come into play for most investors is when, advisors like ourselves and like everybody else in the industry are building a portfolio that's designed, particularly to provide retirement income at some point in time down the road. You'll often hear this number mix get talked about, whether it's 50-50, 70-30, 80-20, 90-10. All of those different numbers that you hear kind of thrown around, what the underlying meaning there is, and it's really important to understand this, is the first number is the equity number, right? So that's your stocks, mutual funds or other truly market-based investments. And then the second number is your bond allocation, right? So you might be participating in a 70-30 portfolio, but as far as you don't own any bonds. Well, in reality, you do. That 30% number of that portfolio that you're participating in is the allocation that's been applied to fixed income.
Isn't that funny, though, when you meet with people and they don't understand that they own bonds?
No, they typically don't have any idea. Anyway, if you have any money in money markets, you have U.S. Treasuries.
Most people don't know the bond market's like over 2 times as big as the stock market either, so that's okay.
It's so under-discussed. I mean, honestly, it really is. And, it is a foundational element. I mean, people do that, and the reason it's been, throughout the history of investing, it's been that foundational piece of designing a portfolio. It's because the values are, compared to the stock market, expected to be at least relatively stable. Right, so you think that's the safe portion, and it spins off some income, and that can help either provide income directly to you as the investor, or be getting reinvested back into your equity slice. But that foundation, and it's been expected to return and provide income for decades. And the reality is, in the last 10 or so years anyway, and looking forward until we don't know when, it hasn't done what it's traditionally done. And its value to you as the investor as that foundational piece is probably diminished just because of the rate environment we're in, where right now it's very, very low, so it's not spinning off a whole lot of income for you, and it's forecasted to rise, which is just going to devalue the bonds.
Yeah, we chatted about this too. We talked about how we have, and other advisors, when you read more about it, you say, well, I guess we're not the only geniuses out there. That's I'm just kidding. But, but people are literally reducing their bond exposure with high yield stocks. They're saying, hey, why would I buy a Pfizer or a JP Morgan, or why would I buy their bond or lend them money in a bond and get paid, a quarter or 0.5% interest on a devaluing potential asset, or most likely potential asset, versus buying their stock that pays a higher dividend yield. And if they have a good year, my stock value goes up. But meanwhile, I'm just still going to collect just the income, and it's more income than the bond with the same company risk. So now it's not exactly the same risk because you've got market risk and all those different pieces, but that's how people think about it, right? So the value space has gotten attention.
It's probably fair to note, too, though, if a company gets into real trouble, that the bondholders get paid back first.
Exactly. But the question is, with all the Pfizer vaccine shots have been doing, they're not going out of business anytime soon, right? And they got, 20 million boosters that they're planning on, or billion boosters, or whatever it is. So you have all of this stuff. I mean, people don't equate the risk of those two, even though liquidation risk is a different story, right? Mm-hmm. The company goes out. So that's where your junk bonds come into play. And they're likely to go out of business. That's why you're buying junk, So, and when that guy was buying GM bonds, they were considered junk bonds, So
there's probably a red flag there when you go and buying something that's titled junk.
Yeah, no, I think you should probably take that under advisement. It's not a whatever. It's not a joke. But you're right, Dan. So people have been taking that high value, high yield equity space and replacing it. We've done that too. We've said, listen, we really can't have the exposure to these bonds. We're just going to lose money in it. So how do we offset that? We've talked to clients. We've moved risk tolerances. We've adjusted things.
If you're targeting like an 8% return, I just wanted to jump in on that, a 7-8% return on a portfolio, which is a number that people kind of throw around, and it's not necessarily how we do things. But advising in general, if you're in a 60-40 portfolio hoping to return 8% and 40% of the portfolio is making 1%, you're going to take on a heck of a lot of risk on the other 60%, and it's probably undue risk just to try and capture that 8%. So,
well said.
That's you're putting yourself as an equity picker in a tough position there.
Yeah, and then that's where the averages come into play, and that's why people say, hey, here's a 60-40 portfolio. Let's minimize the bond exposure to reduce our 1%, if that's what you're getting.
Right.
Right. So there's a lot of moving pieces there. But, for people who are in retirement, there was this old rule of thumb. Remember that, where you were just saying, hey, listen, the first number is your stock number. The second number people say in your portfolio is your bond percentage. So if you say like a 60-40, you're talking 60% equity stocks, 40% bond exposure. And as that number goes up or down, but people used to say, like, base it on 100. If you're 70 years old, you should have 70% in bonds. And as you get older, you get 80, you get 80% in bonds, because you don't need big exposure. You don't need big returns. You're coming to your, kind of the end of your life. But that was when rates were significantly better. That's when you were getting 3 or 4% in bonds. And today it's like, I can't get even a reasonable retirement just owning all bonds. Like, you get 100 years old, you own all bonds, you're going to go bankrupt. Yeah. Just on the income.
If the market is targeting 8 and your bond portfolio's spinning off 5 or 6, well, you can pick pretty conservatively on the equity side and still get there, still meet your goal. But when that bond number is down to 1 or 2, like we're talking about, or even less, you have to assume a heck of a lot more risk on that equity exposure.
I want to dive into this article we found on Plan Sponsor. I'm just going to bring some stuff out by the CEO, David Lau, who was quoted on a couple of these pieces. I thought it was interesting. It talks about, the average investor and the person who's investing in bonds and using fixed income aggressively. And we use fixed income all the time. It definitely has a place. And if the stock market's crashing, we're not talking about a pullback. We're talking about crashing. Bonds where you want to be. You don't completely want to be out of that. And it's a great asset to be able to reallocate after a crash, right? So it's a healthy thing to have. But he's talking about a couple different things, and one of them was the investor who retired during a bear market would run out of assets within 13 years. Okay, now he's talking about a traditional bond stock portfolio, while the one who retired during a bull market could end up with more assets than he began with. And he talks about sequence of return risk, and we've talked about our video that's on our website at BrayshawFinancial.com, which is called Sequence of Returns, ironically. And it shows how similar people doing exactly the same type of investing with the same strategy, investing just a couple years apart in the exact same investments, one becomes super wealthy, one becomes poor, one runs out of money. The biggest fear in retirement is running out of money. The number one fear in retirement is running out of money. And everyone who is looking at retirement or thinking about retirement is saying, I got to put more away. I got to put more away, so that fear gets less and less and less because I don't know how to solve that problem. No pension, no problem. This conversation today is about solving that problem. And if you don't feel secure in that, that's when you should reach out to us. It goes on to this. It says, according to Lau, a survey of advisors found that with a low yield bond market, 57% of respondents said they would bridge the gap between desired retirement income and yields from bond portfolios by allocating more heavily to dividend-paying stocks, something we did a year ago.
Yeah. You know what? You highlighted something there, Ben, that actually both of you guys, I was just really, really having a hard time, not taking the conversation off in these other directions. But to bring it back, what can you right now as an investor grab for yourself to get really familiar and comfortable with some of the concepts that we're talking about? If you're listening to us on a podcast right now, push the pause right now. Go to BrayshawFinancial.com. Go all the way over to the right, and it says resources. It's right next to case studies. And if you click on that, you will see retirement roadblocks is the first tab down. Okay. And there's 7 videos that we have there for you. They're on an average 2 minutes a piece or something like that, going to cover sequence of returns. And that's the one that we talk about more often than not here. But there's also inflation, Social Security. I would ask you, please go and spend 14 minutes, right? 7 videos, 2 minutes each, 14 minutes for you to become familiarized with the risks that are involved for you as an investor and in your retirement. And then come back right here, because we're going to be talking about very, very critical, important pieces of your retirement and this equation of this or the solution of fixed income retirement investing. And one of the pieces there, that traditional piece of how do you create your income in retirement is called a bond ladder. And if you're not familiar with what that is, it's actually because of the low interest rates that have been happening. It's not a conversation that, frankly, we're having a lot of time having conversations around, because it's so hard to solve fixed income or that income need through the bond world in that traditional sense. But it's good to note that, just as we're talking about duration and quality of these bonds and, all these other pieces around the fixed income world, for just you to have an understanding, what is this? How does this work? It's probably something in the future that we will have more conversation around. But you can create income for yourself using bonds, and there's duration, and there's all things to consider here. It's like how long that bond is going to be until it stops paying income. That's what it's doing for this period of time, and then it becomes liquid again. And what, based off of the rating there, is it AAA rated? Is it B rated? Those are the kind of the risk reward ratings in the bond world. Typically, you're going to get less income from something that has that super high rating of very, very low risk. And that starts with your treasuries from the government as like almost considered a zero risk in terms of what those are considered out there. Like they're a guarantee to pay you whatever you put in and continue to get that income over that period of time, 1 year, 3 year, 10 year, whatever. Those are the treasuries. And then get you that money back. But you have in this environment, the other risk of that is that low interest rate, and that's that time period that you hold that, and you're going to hold it. You want to hold that typically for that time period to get that money back and then reallocate it. But when you reallocate that money, you have a whole other risk there because you don't know what are the rates going to be, what's going to be available in the marketplace for that super secure money. That's what that's been to put that back to work for you. So that's another risk to consider there. But bond ladders don't work like your funds, your bond funds. Those are very different. But how this works is you buy like a 1 year bond, and that's going to give you income for that year, and then that comes due, and you get that money back, and then you reallocate it, and that's leading into the next bond that's been laddered out there for 3 years or 5 years, 10 years, and people build bond ladders for 30 years of income. That's the most risk-averse way to do that. But, it's just one of these strategies that has been typically implemented in this for creating income.
Seth, one of the things that a lot of people don't realize is I used to have a lot of people in bond ladders, and that was when rates were good. The biggest problem with bond ladders that people haven't realized in a declining interest rate environment, right? You buy a bond that's paying you 5%, and then fast forward, you bought a 30-year ladder, and great, that bond just finished, and you got this new money coming into play, but now the bond you're buying is 0.5%. And that's reinvestment risk. And that's really where bonds have just crashed on people in that strategy. It's worked for a lot of people for a long time, but now you've got 75, 80, 85-year-old people who are running out of bonds. They can't replace their bonds, and that's a big issue.
One of the things I wanted to mention in that too, this is also the fixed income world, but people have done this kind of the same strategy, and sometimes it's easier for people to conceptualize this is around CDs because everybody's pretty much seen what a CD is at the bank, paying you X amount for that period of time. But you leave it there for that period of time, and then when it becomes due, then they give you the money back, and then you reinvest it. And what Ben was just talking about is like the idea is that you're going to be able to typically you're going to be able to reinvest that money at the rate that you had previously or higher, but that just hasn't happened in a decreasing rate world. So you have to take that money and try to figure out a different solve.
Absolutely. I want to jump back because we're getting close on time here, and I want to run through a couple pieces because we talked about the first section. We talked about annuities being one big slice of the pie. We're talking about fixed income. Next week we're going to talk about equities and some of the plays inside of that space, and I'm pretty excited about that show as well. But going back to that plan sponsor article, Dan and Seth, I thought it was interesting because going on in the article, it actually brings the conversation, which is not an annuity conversation. It's about fixed income. But they had done the research to say that 38% of advisors surveyed said they are allocating a portion of their clients' portfolios to annuities. Now, this is where it gets good, folks, and I think this is really, really important for our listeners. Okay? Two pieces. In an illustration of two scenarios for a portfolio with a 50% stocks and 50% bonds and historical capital market assumptions, you'd have about a 90% success rate for generating enough assets for retirement. So what they're talking about is they're not talking about today's rates on bonds. They're talking about rates that used to be historical, more in the 4 or 5% range is what I'm reading into that. But with today's low interest rates, I'm quoting this now, but again, with today's low interest rates, the 50-50 portfolio actually only has a 37% success rate. So historically, this story worked at a 90% success rate, and now it's at a 37%, which is a huge, huge decline. So what they did was they actually said, okay, well, let's move a portion of that 50-50 stock bond portfolio. Let's make it 70% stocks and 30% bonds in today's marketplace. And they said that the success rate moved to 60%. Then they said, what if we wanted to get to a greater success rate. They said if we took 30%, the 30% that was allocated to bonds still, if they took 20% of that and moved that to an annuity. So you had 70% equities, 20% an annuity. And they're talking fixed annuities. They're not even talking about variable or any equity exposure at all. 20% to fixed annuities and 10% to bonds. Your success rate went to 72%. They're basically dumping the bonds down to 10%, which is unbelievable that it requires that.
But you know what I really love about this, though, is that it's not an all-in approach, and it's not kind of this blind, like we don't take a look at all sides of the issues approach. Really, it is addressing the issue and moving parts of the dial here. What are our solves here, and kind of grabbing those pieces and moving them into places where, it's realistic is where I come back to, and it's not a sales approach into the let's just sell you an annuity today.
Yeah, no, I think so too. And he goes on. He talks about Hugh Penny, who's he's the director of compensation and benefits at Yale University, and he starts talking, and they're going into the conversation of annuities because they use TIAA-CREF, and they have no bond funds in the guaranteed annuity investment.
That right there is significant. Like, for people that don't even understand what Ben is, like, what we're talking about, that is so huge to say TIAA-CREF, which is massive in this industry, in the 403B space, 401k space. Like, they just do a significant amount of business to say, no, we're going to move away from this bond fund piece.
Yeah, this is Yale. This is not a podunk. I mean, they're
no.
They've got an enormous endowment.
Smart people.
They know. Well, that's what they say. I don't know. We'll see. But
I mean, it's nice that they come to us every once in a while for some advice, but they're fairly smart.
Yeah, and so so they're talking about all this stuff, and this guy Fink, he goes, buying annuities costs less than buying bonds based on the price of income. I think that's an interesting perspective, that you're getting more income than the costs associated, and therefore bonds are actually more expensive than annuities in today's marketplace and the low yield environment. They use the illustration, and I'm quoting the article. They said it might cost you $500,000 in a bond portfolio to create a $20,000 a year income till age 100 with a 9% failure rate. The data illustrated that a 10-year certain lifetime fixed income annuity would cost $374,000, and there would be no concern of age and no failure rate. So that's interesting, and I think for a conversation of where fixed income is going, it is, and I think the point I would make today is that it's a moving target.
Yes, someday rates may return to where it's a viable component of a portfolio in retirement planning, for the average investor, but, we're a ways off from that being the story again.
Yeah.
Wow. That is it for us today. It's awesome to be able to come up with solutions and really get into this place where we're working through the real world of your financial picture, your retirement solution. There's just a lot of confidence to be able to move forward into this space in these next conversations that we're going to be able to have with you. You're listening to Money on Tap. You reach us at 855-226-8551 or info@yourmoneyontap.com. And if we did not mention, we've got loads of resources here for you. If this is your first step in this process, we're grateful. If you've already been working with somebody, we're grateful as well. And hopefully this is something that you can take forward with you and circle back with us on some of the questions that you have. Make it a great week, folks. You've been listening to Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551. All guarantees, protections are subject to the claims paying ability of the issuing insurance company. Mutual funds and variable annuities are sold by prospectus. Please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus, which contains this and other information about the mutual fund and the variable annuity contract and underlying funds, can be obtained from your financial professional. Be sure to read the prospectus carefully before deciding whether to invest. Fixed annuities are insurance products and are designed for long-term retirement income. Annuity guarantees are subject to the claims-paying ability of the insurance company. Surrender charges may apply if money is withdrawn before the end of the surrender period. All withdrawals of tax-deferred earnings are subject to current income tax, and if made prior to age 59 and a half, may also be subject to a 10% federal income tax penalty. Annuities generally contain fees and charges which include, but are not limited to, sales and surrender charges. Additionally, if purchased within a qualified plan, an annuity will provide no further tax deferral features. The contract, when redeemed, may be worth more or less than the amount used to purchase the annuity. Fixed annuities are contracts, and you should read and understand the contract before making a purchasing decision. All other benefits are available for an additional cost. It is important to weigh the costs against the benefits when adding such options to an annuity contract. An income rider or benefit, sometimes called Guaranteed Lifetime Withdrawal Benefits, or GLWB, is an additional feature available with some annuities and generally optional and comes with additional cost. Income benefits are designed to provide income options above and beyond the standard annuitization or free withdrawal features in annuities.
Well, bye.